Hey, what's up? Welcome to Degen Ed. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts, and in this video, doing a book review, starting a book club with the goal of improving my financial literacy and skills as a trader, whether that's looking at the market or just managing money, thinking about the psychology of money. And so for the first book review of the year, I read the book, The Psychology of Money, for the month of January. And I will be doing a book every month for this year. So make sure you subscribe to the channel if you'd like to follow along and learn with me as I read these books. And I will reveal February's book at the end of this video. So make sure you watch the whole thing for that. But so for this video, for this book, I, read the one that's here, The Psychology of Money by Morgan Housel. And, I just wanted to share my thoughts on it, some things that stood out for me as I am running this channel, thinking about that, as well as, just trying to improve my trading and my management of money. And to begin with it, I just thought it'd be nice to throw up a profile here of Morgan Housel, the author of the book. And so he is a partner at the Collaborative Fund and a former columnist at the Motley Fool and the Wall Street Journal. He's also won a number of awards and, is a distinguished business and financial journalist. And you can really tell by the book how it's written. Very easy to read, very enjoyable. And I couldn't recommend it higher, whether you're really interested in trading or if you're just interested in getting better at managing your savings account. I think this is a great book, very easy read. And so the book contains 20 chapters. All of them are about 10 pages long. So they're very easy to read. They're not too dense. There are some graphs in them that help illustrate the points that he's trying to make. And yeah, it's just a breeze. I've spent many mornings over the course of the month enjoying reading this over coffee, on the couch, also at diners, and even, because the chapters are only 10 pages long, I was able to enjoy some of it while at work on breaks without having to stop in the middle of a chapter, having to get back to it later. So it was just super, super easy to read. And whether you're interested in diving into the technicals, the fundamentals, or, just wanting to get a little bit of a better handle of money, this book couldn't be better for you, at least especially to get started on the journey of getting better at managing money and the psychology of it. And so I think this is a perfect book to start this book club. And I just can't express how much I enjoyed it and how much I would recommend it. And so from this table of contents, I'm going to go over just some of my basic thoughts over some of the chapters. I believe I've highlighted 10, or actually 11, that are marked by these red dots. And so I'm just going to go over them and just kind of share some of my perspective on those chapters and, just some of the takeaways that I've had, whether it's, specifically from the book or just how the book has made me think more about my approach to money, whether that's in the markets or really, just my savings account, stuff like that. I'm just going to dive into the first one, which is the first chapter entitled No One's Crazy. And so from this chapter, I think, really just kind of the takeaway as I've been managing this channel and getting to know subscribers, interacting with those who watch the channel, I've recognized that there is quite a spread in the ages of those who watch the channel. And also, for myself as a millennial, I've found lots of comparisons, whether it's with the baby boomer generation, Gen X, or, Gen Z. I find that there are so many different contrasts between the generations just because of, how technology has been changing so rapidly. But also here, I think this is a really nice example of how, just depending on when you're born, the market behaves very differently. So like if you're born in the 1950s, the market was flat. So you probably weren't interested in investing when you're in your teens and 20s because, you're not going to get any gains. But if you're born in the 70s, you're probably thinking, everybody should be investing because your experience in the market was much different than those that were 20 years younger than you. So I think that this is a really nice way to look at how everybody experiences the market very differently. But, we're all here at the same time now. How can we be learning together to better improve the performance of our portfolios and to better improve the management of our money? So, I just think this is a really nice example that we're all coming from very, very different places, but we're all here now experiencing the same market. How can we learn together? How can we improve together? And that's what this channel is all about. So I think that this is a really nice graphic to show, the differences that we've had in our lives coming now to this time together. And then, so the next chapter that I have highlighted is chapter 2, and this chapter is entitled Luck and Risk. And so this really centers around Bill Gates, Paul Allen, and Ken Evans, and how they happened to be very lucky when going to high school because they went to, I believe, the only high school in the country that had access to a computer. And so they were in the computer club. They spent all of their time doing this stuff with computers. And, that is all based on luck. They were lucky in that they happened to go to that high school. And from that, they built Microsoft that, I'm currently using a Microsoft computer program right here. This is PowerPoint. And so that is because of this luck that they had in going to that high school. But also there's risk as well. And so I have Ken Evans in parentheses here because he unfortunately passed away in high school due to a tragic mountaineering accident. And, so they were all very lucky. But, on one side of luck, there's this other side of risk. And he just happened to have, the unfortunate side of risk in life and passed away too young. And, that for me, I gravitate towards stories of loss like this. I really identify with them. And so I just thought it was a really beautiful story. And it also reminds me of the biography of Steve Jobs and, just his story and how, we tragically lost him. But just like the innovations and really, the luck that he had growing up at the time that he did. And I just think that this is a really nice, beautiful chapter, on luck and risk and life and loss. And so, I just thought this was a really nice chapter and also relating to the markets and the success of Microsoft because, it's just... it's one of the Magnificent Seven, and it's been that way for a while. And so, I just think it's a really nice story here. And then continuing on with this, actually talking more about, Warren Buffett and compounding interest. And so this chapter, chapter 4, is entitled Confounding Compounding, and it's on compounding interest or compounding gains. And I thought there was a really nice analogy or metaphor used in the book on Milankovitch cycles, which I'm not sure if you're aware of what those are. It's basically just like there are subtle differences in Earth's orbit that affect ice ages, stuff like that. And basically how, when the Earth gets subtly further away from the sun as it does over here, in that time, over winters and summers, you get less melting, you get more accumulation of snow and ice, and that's how you get ice ages. And that little bit of accumulation really adds up to a lot to create ice ages. And that is a nice metaphor for compounding gains, like Warren Buffett's approach to the market. You buy and you hold and you forget about it. And he's accumulated so much wealth with that approach, just like how ice ages have in geologic time accumulated so much ice and snow that you wouldn't notice it between the years, but over time, you really do notice it. And so I just thought this was a really nice analogy. Also, you may not be aware of this, but my background is in earth science. I'm actually an oceanographer. So it's really nice to see something so complicated like this explained in such a succinct way, in a way that captures people's interest, putting it around money, centering it around money, because I've found that in my pursuits of communicating earth science, people just aren't really that interested in it. It's fairly boring. So I thought this was a really nice example lesson in earth science as well as money management and investing. So I thought that was really cool. I really like this chapter a lot. And then continuing on with Warren Buffett, the next chapter, chapter 5, is on getting wealthy versus staying wealthy. And in this chapter, it really talks about, Berkshire Hathaway, led by Warren Buffett and Charlie Munger, the late Charlie Munger, rest in peace. And also Rick Guerin. I have his name in red there because he used to be, it was a trio. He used to be one of the trios, the Three Musketeers, I guess you could say, with these guys. But he used too much leverage. And because of that, he got smoked out. He didn't stick around like Warren Buffett and Charlie Munger were able to, because they didn't get greedy. They focused on getting wealthy and staying wealthy. They didn't worry about racing to the wealth. They just wanted to get there in time. And whereas Rick Guerin, he used leverage and he got out. I believe 40 years ago is what it says in the book, that he left the fund. And so that, I think, is a really nice example for me of, whether it's getting in leveraged plays, like I've done that with natural gas with ticker symbol BOIL, which is 2x leveraged. I've stopped doing that because I felt it was too risky. However, right now, looking at how the market is, I am starting to build a position in 3x leveraged short semiconductors, ticker symbol SOXS. And, I've been cautious with that one. I've eased my way into it because I don't want to get too heavy in leverage. And also just with the examples of losing money on options, buying options, I tend to, try and chase quick gains. But I need to be more disciplined in not being like Rick. I need to be more like Warren and Charlie and, just be content with slow yet less risky gains and stacking those gains over times, because I don't want to burn out my account, blow up my account like Rick did. So I think this is a really nice chapter in just kind of managing that greed and focusing on, wanting to, for me, I want to get wealthy. But once I get there, I need to stay wealthy. I need to keep the gains that I get. I don't want to blow them on options or, leveraged positions. And then so moving on, chapter 7, this chapter was entitled Freedom. And really it's just about time and how, if you, aren't working for the man and you have money, you have the freedom to do whatever you want. That's really like, you're buying time. Time is the most valuable asset. And so for me, my motivation when it comes to whether it's investing, trading, or, doing this channel, my motivation is freedom. Not necessarily in the sense of time. I guess, yeah, in the sense of time. I don't want to be working for the man. I want to be working for myself and pursuing my own ideas. And I feel like this chapter is a really nice example of that. And really, I don't want to be I don't want to not work for the man for money. I want to do it for freedom, the pursuit of my ideas, but really to have the time to pursue those ideas. And, every, week that goes by trading the markets, we're losing time. And, I just think that this is a really nice chapter, not just as far as managing money and reaching our goals, but just in life. We want to have freedom. We want to have the time to be with the ones we love. And so I just think that this is a really nice chapter, whether it's related to money or just life. I really liked it a lot. And then chapter 10 is entitled Save Money. So this, I would say, is not really that exciting of a chapter. It really doesn't stand out as being the most exciting thing. Saving money is kind of boring. Most people don't really like doing it. They don't go on about it. But this got me thinking, For me, just to give you a little bit of my financial history, I guess, or an example in my life, over the course of 2023, I started to get a lot of offers for 0% APR credit cards, and I kind of started to accumulate those. And this year, that APR is going to go from zero to, I don't know, higher than zero. And so I need to pay off that credit card debt. And so I was about to, at the beginning of the year, going to take the money that I have in my checking account and start moving that to pay off the credit cards. But then I realized because of this chapter, oh, well, actually, I should move that money into my savings account so I could take advantage of the high APY, the high interest savings account that I have, annual percentage yield, APY, and just stack the money that I have in there rather than paying off the credit cards, and then wait until just before the zero APR goes away and I have to start paying interest, then start moving the money from savings to pay off that credit card, because then I'm making money on that interest. And so I just think, saving money is really important. You don't just want to be investing all of your money because maybe you'll lose it. Maybe, you don't get back the returns that you're expecting. And so I think that saving is a really good way to just secure that, not such an exciting way, but, in a secure way. And that's what you want to be doing with your money. You want to have that as a security. And so I think this chapter was a really nice way to kind of, at least for me, bring myself back to recognize that I need to have money in my savings account to take advantage of that secure APY, and then to utilize that to then pay off credit cards, that will have at some point this year interest coming out on them. So, of course, saving money is really good. I think that's a really nice lesson in that chapter. And then chapter 12 is entitled Surprise. And, I think that this is just a really nice chapter, really based on this sentence, this phrase that the chapter begins with, which is that history is the study of change, but ironically used as a map of the future. And so, I have history and change highlighted in pink, and ironically, and future highlighted in green. And so you really can't be using history to map the future because of this change. And so that there is this irony in that. And I find that, with the charting that I do on the channel, I don't really use moving averages or MAs, highlighted up here. Because I feel like they're lagging indicators. They don't really tell me what's going to be happening in the future of the chart. They tell me what has happened. And so when I see a golden cross, that to me tells me either the top is in or nearly in, and it's just downside. So I don't really think that looking to history, such as using moving averages, which I don't use that often on the channel, I don't really feel that that's a good way to map the future. And I think there's also a quote in this chapter on, there are things that have never happened before, and, they're pretty likely to happen, and vice versa. There are things that have happened before in the past that are likely to never happen again, or maybe, 100-year cycles, things like that. So I do think that this is a nice chapter in kind of framing, this happened last time, it's going to happen again. This chapter, really, I think, is good at suggesting that, it's good to prepare for being surprised. And that is really how, we map the future, is by preparing for the unknowns. Not preparing for what has happened in the past, but being ready for what's to come in the future. And I think especially with all of the technological breakthroughs that we've seen with AI, semiconductors, social media, all of this, the internet, there's just so many unknowns in the future, as well as, like some of the bad stuff like pandemic and future catastrophes that are just, unknown. We have to be prepared for surprises in the future. And so I think this chapter is really nice in kind of laying that out. I really liked it a lot. And I just think it was a really nice chapter just in relation to the market as a whole, or just, trading when using things such as simple moving averages, things like that. The next chapter, chapter 13, which I think is interesting, room for error. Chapter 13, unlucky 13, I'm not really sure. But yeah, room for error. I think it's really good as a trader, as an investor, to factor in that, you might see the bottom at one level, but it's quite possible that you're wrong. You got to leave room for error, and you've got to have a plan for if price does go lower than your target. And especially, if price doesn't hit the target that you're looking for, you've got to think about that. And I think a really nice way to do that is dollar cost averaging, or DCA, which is something that I practice all the time, whether I'm building a position or exiting a position. I tend to not go heavy right away, and I don't tend to sell my entire position all the way at the end. I tend to sell as I'm getting to that target in case the target is not hit. And so, but one thing that I feel like I do need to be improving upon is position size. I oftentimes will dollar cost average into a position. Let's say I buy one share at a time, but I don't have the position size mapped out to, I'm going to have 100 shares. I just end up building to 100 shares. And so rather than just doing like, oh, it's down today, I'm going to add one more share, what I should do, and what I have been getting better at because of this channel, is saying, oh, there's a level here that I think it's going to go to. I'm going to add a quarter of position. So if that's 100 shares, I'm going to buy 25 there. But then whether it's based on a Fibonacci retracement or a level of support that I've identified, whether that's from a volume shelf or just prior consolidation or a gap fill that I see in the past, maybe I want to add another quarter of position below that if it gets to there. And then also consider levels lower than that. And so, rather than buying one share at a time, I should really get better at doing 25 shares at a time so I can build up to 100 shares to then sell covered calls, which is something that I like doing. And so I think that, I need to get better with my room for error, whether that's doing a better job at dollar cost averaging in or out and identifying the right kind of position size. And also on the note of dollar cost averaging out, I tend to be pretty good at that as far as position size, because let's say I have 40 shares of something. I might say, okay, at this level, I'm going to sell 10 shares. And then I keep going up until it's like, it's putting in a reversal signal. I'm going to sell and close that position. So I do think that is something to be considering for both the upside and the downside. And then another thing that, I am really not that good at is stop losses, because I tend to place stop losses where there is support, and then I end up selling at the bottom rather than selling when it breaks that support below it. And something that I did just recently with a stock that I've been going over on the channel is Rivian. I own a small position of that. I had made a video on the bottom for Rivian being right around $15. I do think it's going to bounce from there. It's quite possible, though, that it breaks and continues down to 11. I did put a post out suggesting that might happen. And so what I did, rather than putting a stop loss at $15, I put a stop loss at $14.50, thinking that if it did break to that level, it would continue down, possibly to 11. And so I didn't want to hold the bag. Then I just reestablish a position at $11 or, $11.50, whatever it is. And so I did set a stop loss at $14.50. And I believe the day after I did that, it went down to $14.57. So just above that stop loss. And now price is above $15. And I do feel like, I have more conviction in my analysis that 15 was the bottom. And so I think that was a really nice example of setting a stop loss below support when it would break, and it not breaking, support being respected. And so since then, I have removed that stop loss. But if I do see price return to $14.57 or lower, I might reconsider taking a loss and buying back lower. But hopefully, what I'm hoping is that Rivian rallies in the coming weeks. And so, I just think that's a nice example of a stop loss, and me, at least personally, trying to get better at managing that, allowing room for error, and noting that, I might be wrong. And oftentimes I am. But how do I manage that risk? By doing that, you got to allow room for error. And this chapter is shares some great stories as far as managing that risk. And then this one, I just put the the graphic as red because, in chapter 15, he talks about nothing's free. And I think an example of that is, whether the portfolio is currently red or just some positions. We've all had red positions, red portfolios in the past. And, for me, I view that as, such a valuable lesson, and that I have been, learning so much about the market and applying the mistakes that I've made in the past to make better trades in the future moving forward. And so any losses that I've had in the past or, might be taking moving forward, I learn lessons from those, and those are valuable lessons. So I think that this chapter is a really nice overview of, the cost of things, whether that's paying for education, the time you put into education, whether that's formal education or, education by experimenting with the markets and learning from mistakes. And so I've definitely done a lot of that in my trading career. I'm definitely doing that with the channel now. But by doing videos every week on the same stocks, I'm able to learn from my mistakes and make better moves in the future. And so the cost of those mistakes, I feel, is very valuable because I see in myself that I am getting better as a trader, and I'm able to identify tops better and identify bottoms better. And I'm also getting better at waiting for the tops or bottoms because of mistakes I've made in the past. And so I think that, we've all made mistakes. They're only valuable if we're learning from those mistakes. So I just found this chapter 15, to be really nice as far as that goes. And in this one, I made Ed bigger for this chapter 16, entitled You and Me. And so this chapter is really just about, if you're chatting with somebody, whether it's a friend, family member, coworker, about the stock market, about investments, whether it's savings or retirement, whatever it is, you do have to recognize that nobody is you. You're the only person that is you. And that no matter who you're talking to, they're going to have a different mindset or a different goal with their money, whether that's investing or savings, whatever it is. And so you do have to take that into consideration. And so I just want to point out that, this channel is entitled Degen Ed. It is degenerative education, meaning that I'm going to be making some mistakes here. And, the things that I do or the things that I talk about may not be right for you, whether it's, managing risk or just, position size, thresholds, whether that's tapering out of a position or tapering into one. We're all just very different. And really, I think that comes down to like our psychology in that, let's say I've been burned a lot in the past, so I like to average into things pretty slowly. And I like to have pretty small positions, but I like to make sure that the percentage gains that I have are good so I can better practice having high percentage turnarounds. But then not getting emotional about it by having too large of a position as far as the dollar sign goes. So I don't act emotionally. I just execute based on the levels that I see in the charts. But at the same time, maybe you're the type of person who wants to put a lot of money on something and then just take a 1% gain and leave. And, so everybody's a little bit different. And I, after all, am just some guy on the internet sharing his thoughts on this channel. This is acting as a trading journal for me to be getting better at trading. And so with that, I'm going to be making some mistakes, but I am learning from those mistakes. And so my goal with this channel is that, we can be learning together. You share your ideas in the comments, or if I'm doing a live stream, in the live chat, and we learn together. Call me out for my mistakes, and I will call myself out. That's why I try to do the same stocks every week, because I want to hold myself accountable and I want to be learning from my mistakes. And some of the stocks that I cover, like AMC, I get called out on that being a terrible investment, all of this stuff, that I'm a grifter, and maybe that's not for you, but I try to apply technical analysis to all of the charts that I go over. And so whether you're interested in buying and holding, diamond handing for the rest of your life, or if you want to be taking trades, taking profits, that's all going to be based on technical analysis. And so that's my approach to the market. But, I, of course, could be wrong. And, so that's why I do have in Ed's thought bubble, he's just thinking about bananas. I'm full of shit. Who knows? That's why there's a cat there, because, this is, degen ed. This is kind of stupid. Crayons. I draw on these charts. I might not be right about them. They're just my thoughts. They're just Ed's thoughts. And he's also thinking about stonks, not stocks. So this is supposed to be fun. And hopefully we can be learning together and have fun doing it. And also I got that little fire emoji there too, because, I've been covering natural gas, and I'm, for some reason, so fascinated by it. It is the Widowmaker, but I just really love it. And so anyways, that is, kind of my take on the markets in this channel, my approach to it. And hopefully we can be learning together. I want to be building a community online on YouTube so that we can be learning together as retail, not just diamond handing, but learning about why we're buying at certain levels, why we're selling at other levels, or, why we're never going to sell because we believe in the company, like Warren Buffett has done and made billions of dollars buying and holding for decades. And so I think that's actually a really good approach. And I think it's interesting, that I mention AMC as I'm recording this book review, because, the way that you make a lot of money is not by swinging. It's by holding, and holding something that you really believe in. And so I think that, there are a lot of positions that I hold that I don't plan on selling. But some of them, I plan on trimming. Pretty much all of them I plan on trimming over time. But some of them I plan on seeing for the long term, like Biora Therapeutics. I'm really compelled by that company. Also ChargePoint, really compelled by that company, and that it's been dragged down so much that, I think that it's probably not going to return to these levels for quite a while, and that it could be a really good long-term hold. But that might not be right for you. And so I do try to go over stocks on a weekly basis so that if you do want to swing, you can exit your position. I just had a really nice comment from somebody on, Nicola, following somebody's comment who said, the founder went to jail for fraud. And, I responded to that comment by saying, yeah, but it's up over 6%, over 7% the past week. So based on the video that I said it was at a bottom, that was actually a good call. So it was a good buy. But is it a good hold? I don't know. It's up to you. It depends on what the next video, the next chart, the next week is telling us about it. And this really nice comment from somebody was saying, I'm up 10.5%. And so, we're all different. Our entry points are going to be different. Our averages are going to be different. And our sentiment or our conviction in the place, it's going to be different. And so we got to navigate that, keeping in mind that we're all different. We've got to be respectful to one another. And so my goal is really just to focus on technical analysis and leaving emotions and all that on the side. But sometimes I do get emotional about stuff. I do find myself compelled by either some charts or some companies. But really, I think the charts, the technical analysis, that's really where it's at. That's where my focus is. And that's where the focus of this channel is. It might be different from what you're interested in, but I do find that to be compelling. And anyways, I've spent a lot of time on You and Me. I think there's one or two more chapters to go over. Yes, this is the last chapter. This is on the seduction of pessimism, chapter 17. Not the last chapter of the book, but the last chapter that I'm covering in this book review. And so I feel like, for me at least, I would say I am like an optimist. I feel like I have flaws as being overly optimistic. I just don't want to see people lose money. I don't want to see people hurt. It's just my nature to, see the brighter side of things. Like I wouldn't necessarily say I'm a glass half full person, but I'm the type of person that sees a glass half empty and I say, it's only half empty. I don't really like to look at the downside, or at least I don't like to focus on it. I like to think about the bright side of things, but that's not sexy. It doesn't sell. And so with this chapter on the seduction of pessimism, it's really just like, basically, when things are beaten down, Nobody wants to hear, oh, it's going to the moon. Like with AMC, nobody wants to hear it's going up because it just keeps bleeding. And there's just this seduction of the bearish coverage of certain stocks or certain things. And also with the market, as I have pictured here, this is the SPX, which is the ETF that tracks the S&P 500. And so this chart shows prices going back to 1982, right around $100 a share. And this trend line that I have drawn there, we have not seen any monthly closes or opens below that trend line. So here we have the dot-com bubble bursting, coming down there. Here we have the financial crisis, did dip below that level, but we did not get a monthly open or close below that line. And then since then, we've just been going on a rampage, going up. This right here, this drop, this is the pandemic, COVID crash. We did not get a full correction down to this level. And following that, we've seen all-time highs in the markets. And most recently, we hit above $4,900 or $4,900, which beat the recent high that occurred following the pandemic, which is at $4,800. And so, there's a lot of seduction in this is going to collapse. I have these gaps highlighted here that need to get filled. We are seeing a higher high, so potentially that's bullish. But if you look at the RSI, we see a bearish divergence. And so that could suggest at some point, maybe this goes to 5,000, who knows? But at some point, this is going to correct, whether it's just to fill these gaps, whether it's to meet this low down here, or return to the COVID lows. Or, maybe there's going to be a major correction and we're going to return to this white line. And so, I do think that there's, while I feel like I am an optimist, there is this intrigue of such a correction. When are we going to get the recession? I thought we were going to get one last year. Are we going to get it this year? Maybe next year? When are we going to get this correction? And so that's just something that's always being talked about. And I think it's something good to keep in mind as far as, being able to at least hedge or pivot if things do turn around. How are we going to handle that? But at the same time, we don't want to be a too early bear like, Michael Burry, who, made a lot of money on the financial crisis back here with the big short. But if you're constantly being short and the market keeps going up, eventually you're going to be right. Eventually, we might pull back to these levels over here. But at the same time, in that time, from the lows here, you've just been losing money if you're short or if you're being, an eternal pessimist. So I do think that this is a really interesting take on the markets and really just the sentiment and psychology of, around pessimism. And, pessimism sells, whereas optimism does not. So, I think that's a really interesting chapter, chapter 17, which is not the last chapter of the book, but there are, a number of great chapters that are short stories in the book. And, I just found it a wonderful, wonderful read. I would recommend it to anybody who is interested in whether it's just managing money, trading, stock market, crypto, whatever. I think The Psychology of Money is a great, great book. And so I'd highly recommend it. And on that note, my recommendations next month for February, I'm going to be reading the book by Peter Lynch, One Up on Wall Street. And I'll be doing another book review at the end of the month. And I'd be happy to do that as a live stream if you'd prefer. So if you enjoyed this book review and you'd like to see the next one, but you'd like to interact with me more on it so we can really be chatting about it in the live chat as a book club, let me know in the comments of this video. I'd be happy to do that. But yeah, my goal is to read a book every month for this year and to do a review of the book and start this book club to be improving my financial literacy, whether that's as a trader, an investor, a saver, a hodler, or, just a YouTuber trying to be better at what I do and to make improvements to my my trade, whether that's, in YouTube or, in trading. So, those are my thoughts on this book. If you found them helpful, enjoyable, make sure you like the video and subscribe to the channel. I'll be doing book reviews every month at the end of the month, and I'll see you at the end of February when I go over One Up on Wall Street. Thank you so much for watching. Take care.